Hello, everyone. Good Monday to you. Let's have a great week. I'm Dale Pinkert. I'm your anchor here in the best online mastermind community on the net. How's everyone doing today? Just a quick view of the charts. I don't think the dollar low is in yet. Cable has taken over the leadership here. There was still the possibility of 113, but still looking for new highs in the euro. Still have a lot of confluence up here around this 115 and a quarter level up here. Still think that's where we could go. And in fact, although we had divergence on the NFP, it wasn't the greatest divergence. Reading was over 70. But it looks to me like cable's trying to take over the leadership, as EG is showing for the first time potential topping pattern, although I don't like this EG top. I think we had a confirmed high here, it moved sideways and rolled over. So I still think there's another move coming, maybe up towards 81, and still no divergence on the 1 hour time frame. So still think we could turn it up one more time in euro pound. Those are my thoughts coming into this Monday morning. I know Lars probably got a lot more ideas than I do individually. So let me just see who's in the house here today. GM, Luca, how are you? Jake, Ron, Tosin, how are you? Norm Winsky's going to be with us on the 7th, so that tells me that's probably where we're going to have some reversals. How are you, Tosin? Khalid, how are you? Jake, Ball Guy, Carol, Ed Z. How's everyone doing today? So my view is there's another push down in the dollar. We did have some divergence, but I think there could still be one more move up in the pound. Could we go down to 1.5 first? Sure. Hello, Pegasus. How are you? So what is the community thinking this fine April 4th Monday? Hello, Midas. How are you doing? Here's the Dixie chart. So just want to show you the form that it might be getting late to be pushing this, although I think there's one more high left in the euro. Well, look, we have 1, 2, 3 on the Dixie. Inside day, I think 94 is going to be an important area. I think we're starting to grind something out here. If I just cover the title of the chart, this isn't an area I'd be thinking about getting short. Up here, yeah. Down here, not so much. So you don't have to agree with me. I just want to show you that in the Dixie, just like the euro, we already have 3 drives. Hi, Zig. How are you? Sinatra, how's it going? Refat, welcome back. Hello, Abel. How are you, buddy? So do we have any screenshots or views to share coming into today? I was just bragging about you guys. Ricardo's in the house. Views, ideas, setups. What's the community thinking? You guys know what I'm thinking. Okay, so 50% retrace. And Luca, you're looking for 40-50, right? Still are some people talking about 46. Okay, 41.50. Back here. There's a nice look by Luca. So we have one more jiggle down in the pound, and then maybe it goes to 46. Let's see. I want to thank Luca for his view. He just got short at the 50% retracement of this move right here. Thanks for the live trade call, Luca. Everyone thank Luca and wish him well on the trade. Good hunting on the trade. Okay, so that's it. We're done. Here's your own third drive, Tosin. On Euro pound. So you already got it. Oh, I see. This is a daily. Okay. 1, 2, 3. Everyone thank Tosin. I believe he's short here with stops over 80.50. Thank you, Tosin. Anything else here? Everyone thank Luca and Tosin for their views, one on pound, one on Euro pound. So we're on the same page. I just think we might get one more shot. Maybe you're right, Tosin. Thank you, Tosin. Thank you, Luca. Thank you, guys. What are you thinking, Midas? So we're going to have the winner of best sell side analysis, Gregor Horvat, is going to be with us. Okay. And then I have Corvin Cordirla with us in the second hour. That's where my lines come in. Exactly where my lines come in. 1560. Right here. Here's a daily confluence at 1560 Midas. Right up here. I agree with you. Probably see it better on the 4 hour. Yeah, both of these lines intersect up here. And this was the daily backtest line from that worked from 114, worked from here. Okay. 110 to 106. Jake's looking to short the pound higher. We're here. Nice look on the pound. Thank you, Jake. Hello, Brooke. So stick around for Gregor Horvat. EW forecast, EW-forecast is his company. Everyone doing all right? Thank you, Rick. Any other new handles in here today? Hello, Dion. Carol, welcome back. Hello, Fame. Pegasus is here today. What are you thinking in here, Ron? Pegasus? Other Top Guns? Khalid, what are you thinking, brother? Thank you, everyone, for your shares. So here's my Frank Sinatra song for the S&Ps this year. That's life. That's what people say. You're flying high in April, shot down in May. So that's the S&P song. Flying high in April, shot down in May. But boy, am I going to be singing that tune when I'm back on top in June. Another look from Jake in the oil. Neckline, maybe get a right shoulder here. Nice look, Jake. Everyone thank Jake for a potential head and shoulders developing in the oil. Rick, nothing came up on that. Hello, Jamie. Nice to meet you. You're not Jamie Coleman, are you? Thank you, Luca. That was Luca in the oil. Luke Oil. Thank you, Luca. Hello, Gregor.
Yes, hello, Dale. Can you
It's
see
very
me?
nice to meet you, Gregor. I think it's the first time you and I have ever spoken together. I've
Yes,
seen your work on. I've seen
yes,
your stuff. I go and I look at your wave projections every once in a while on FX Street. I want to congratulate you for winning the trophy for best sell side contributor.
yeah, thank you very much. It's been time. We were trying this very hard for the last couple of years, so we finally got it. It seems that we have more and more clients and regular visitors and readers that support us. So it's very nice.
Yeah, Donald Trump would take the victory. You finished high in the polls. So I'm hearing chants like Gregor Horvat for president of the United States. Are you ready to take that on?
Yeah, I don't know. It's a tough job.
Tough job. So
yeah.
I'd like to, if you have a little bit of time today, the most difficult part of the journey, Gregor, is when people first start out in the business. So maybe you could tell the community how it began for you, what was the catalyst for you becoming a trader, how you gravitated towards Elliott as being your technical discipline, who influenced you, obviously, who were your teachers in Elliott? Did you just take R.N. Elliott's book and learn yourself, self-taught Elliottian, or did you have mentors yourself?
Actually, I started with FX for the first time I heard for it. It was probably 10 years back or so.
Uh-huh.
I was actually doing some jobs, some other jobs in the office. I was writing some administrative stuff, but the friend of mine was actually trading at that time, so I didn't know what actually he's doing back then. But I was getting more and more interested into this. So actually, he gave me some guidance how to look into the markets and some details. And actually, it was very interesting because he had some bookmarks in his Explorer, and actually I followed some of analysis, and I found that analysis from Todd Gordon. You know Todd Gordon, right?
Oh, yes, yes.
Yes,
Okay.
he's a very-known wave business. So actually, back then I was just reading his articles, nothing else, and I was looking at his charts that were labeled with Fibos and Elliott waves. And but back then I actually didn't know what I'm looking at. Okay, so I don't know if he knew at that back at that time because it was also at start of his career. So I'm always saying if I'm wrong with the Elliott waves labeling, then Todd Gordon's fault because he is the guy who gave me the orientation for the markets based on Elliott
All
waves.
right. Well, you know what? I'll speak for Todd. There's always an alternate count. How about
Yes,
that?
that's true.
So you're, you know, as an Elliotician, you're never wrong because there's always an alternate.
Yes, it's
You might
you
have
know
a
market.
preferred count, but you also have alternates, right?
Yes, that's true, but it's not about Elliott wave. It's how you have approach to the markets. It's all about the interpretation. You just need to find Elliott wave so that fits your style. It doesn't. Sometimes my wave count is wrong. Okay,
Yeah.
it's
Yeah.
but actually it's not about the wave count. It's about the prediction for the next movement. Okay, so
Right.
for example, I am predicting wave 3, but actually it will prove to be wave C, but I will still be able to make money on this move. So it's not about the whole cycle of the Elliott wave that you need to be correct on. It's enough to be correct just on one part and be able to make money from that.
Yeah, and 3 and C's are usually fib extensions of A's or 1s, so they're money waves anyway, right?
Yes, exactly. They are probably the most traded patterns in the Elliott wave, probably the most easiest. But I always like to look also on other indicators such as candlesticks. I love candlesticks. You know, at the end of the day, prices is probably the most important price of the day. So, for example, if the market is up during the day, but the whole cycle is reversed at the US close, then this tells you that the bears are much stronger. So obviously,
Right.
at this stage, I will probably be more focused on the downside the next day. And if I
Okay,
have,
so all the intraday stuff is noise, and really the most significant, most heavily weighted indicator is how you finish on the day. That's how the vote. That's a yes or no vote for an instrument.
exactly. So sometimes with the clients, we are waiting on one trade. We're tracking one price action. For example, I was personally tracking euro dollar very closely on Friday. And if we would got a very strong sell-off, and if the week, and actually on Friday, if we'll get a very nice and strong drop, and the price would close at the end of the day and would stay very low, then probably we would continue to shorten it today on a pullback. But
Okay, so that didn't happen. So maybe you could show us your desktop.
yes,
You
sure.
know, yeah, you just, you know, the screen share, you go up to the upper left-hand corner, green box, white arrow.
Yes, yes, I see it.
And you click that. So I'm not sure I understood you. You were writing articles for FX Street before you became a trader. Is that what you said earlier in the interview? Or
No.
you were writing articles for somebody?
Yeah, I was doing for somebody else, yes, and I was contributing on a lot of places. But on the FX Street, I just stayed here because I love your website and your work, and it's really good cooperation with the FX Street stuff. So
Okay, so we're looking at an S&P chart here. Your
Yes.
conclusion is that we're close to a top up here.
Yes, here is very interesting. I'll show you the daily chart. Okay, actually, I'm looking just for the short-term top, nothing significant. So,
Okay.
firstly, actually, we can look on the monthly. Okay, as you know, a lot of traders were very bearish at the start of the year. As you know, you probably read about all this in media. Everyone turned bearish after a very strong blacks down in the first few weeks of January. But I just looked on this monthly chart back then, and actually, I just have no clue how to be bearish in this. You know, we have a very clear bullish cycle. If you're familiar with the Elliott wave, which I believe you are, then you know that this was clearly a nice three-wave pullback. Okay, here in a monthly level.
Yeah.
We are also above this support line, so you just must stay with the trend with this cycle because it's just so strong that I don't see a reason why would you fight this. You know, when the market turns, it will turn only once. Okay, but continuations will occur over and over again within one cycle. So that's just my interpretation that you always need to stay with the trend. It's very simple. So actually, here on daily chart, we have seen some nice break above this first trend line, but there is a second trend line resistance that could send prices slightly down into a new pullback, I guess. So I'm personally will pay attention to this pullback for potential longs. But as this thing stands right now, I just think that market is quite high here in this wave 5 of extended wave 3, so definitely free wave retracement is welcomed for sure. As I said, this trend line is my major, it's probably the most important for this pullback that I'm anticipating.
And that comes in around 2080 or so?
2085. Yes, around here, yes.
Okay.
2080, 2085.
So you were talking about the euro on Friday, that if it had not recovered, you would have been looking to short the euro. So what's the structure to you on the euro? I know a lot of Elliotticians are calling this whole thing in the euro a wave 4. Is it still a wave 4 or something else going on?
Yes, it's actually, when it comes to predicting a reversal or continuation patterns, you just need to look at the substructure. And if any substructure from any bottom or any high is in three waves, then you know it's either completed correction or it's part of a complex correction. So back here in March of 2015, low to high of August of this year was clearly a three-wave movement. Okay, so back then I thought that this was end of a correction and that we are going straight down. But since we are just trapped here in this big consolidation of what, 1,300 pips, it looks like that we are just going complex here, but probably we will turn down, I think, by the end of the year, down into this, for parity, actually. I would be looking for euro-dollar to drop to 1 against 1. So
just go to parity.
Yes.
And to you, it looks like the euro should not take out 115 or so for that last count to be on your daily valid. 115, 115.50.
The real invalidation level is at 170.
Okay.
This is the top from August of 2015. But I'm looking here at 115 as very interesting resistance. You see 78.6% of this movement. Then we have clearly a corrective substructure. It's a double zigzag combination. Okay. The most important here is that we cannot count this rally up from December low as an impulsive wave. Okay, so if it's not impulse, then it's correction. So I see.
Okay, so is there any? You know, I've talked to other Elliotticians, and what this one guy told me is that almost everything, unlike the S&Ps, like you showed earlier, that because it's a conflict between central bankers, that almost everything in FX is corrective. Majority of waves are corrective. rather than impulsive. Do you disagree with that?
Actually, if you take a look on dollar CAD, then I think we should say that move to the downside is clearly impulsive on dollar CAD. So I'm not sure if all majors are in the same degree. But but based on the last few months, maybe commodity, when the euro, pound, and maybe Swiss franc will turn down against the dollar, okay, then maybe some money flows will go into CAD and Aussie to save those gains. So I think that dollar may not gain so much against the commodity currencies like it would against the euro or pound.
Okay, so the higher yielders should hold up better during bouts of dollar strength. Is that what you're saying?
Yes. If we take a look
at the weakest sister, let me guess, would be cable.
Cable, yes, it could be. It could be cable because I see euro pound is in bullish mode actually. Okay, so euro is probably stronger than pound, which means that pound is the weakest when we compare everyone to dollar. So yes, cable, I think it could go lower. I can take a look on cable here. Also, recently I said that dollar CAD and crude oil. If we consider that, look where crude oil is. Okay, crude oil is turning down. Okay, and usually in normal correlations you would see dollar CAD going much higher, right? If crude oil is
and it's not happening. Yeah.
Yes, it's not happening.
Yeah.
So imagine when crude oil bottoms or slows down, then I think that dollar CAD will have no chances to rise. If it's not rising now, when it will? Okay, just connecting it with the energy markets. So that's why I think that upside on dollar CAD could be limited, and that we are turning aggressively down for the next couple of months. So regarding
so that 147 was it. What are you thinking? 120 or lower?
Where on dollar CAD?
USD CAD. If you're USD CAD.
Yes.
Okay.
Do you see these charts nice or should
I see it. Yeah, I see it.
Okay, you see clearly there is a 5-wave decline. You can see this top formation. It cannot be more powerful than this. When you have a strong rally like this and fully retraced in the same period, actually, if you compare current bears with the previous bulls, then for me this is a very nice example of very powerful reversal. So I just think that we will continue to the downside on dollar CAD, but we are now here at this major support at 12830. Yeah. It represents the former wave 4, so I think we can see some bounce. Maybe even bearish head and shoulders could be forming here on a big degree. Left shoulder, head, right shoulder now in play. So we'll see what happens.
I wasn't expecting to get all these great looks. How about gold? Gold's been the star of the first quarter. What are you thinking in here?
Gold, I think that gold is going higher. I'm actually, recently we talked about two different views. You have primary and alternate view, right? So here I'm looking actually at 2 wave counts, and I don't care which wave count is correct. To me it's important that we focus on a 1 wave at a time. Okay, so it means either we will see only ABC movement to the upside or 1, 2, 3, 4, 5. In both cases, there's room for much higher levels. Notice that we broke here above this major resistance line of this downward channel, but more importantly was this ending diagonal formation. That's probably one of the most powerful patterns. And once they are finished, market will just move very sharply in the totally opposite direction, which usually happens because there are a lot of traders that will avoid those slow price action. Like here, there were some overlaps, but the bears were not so aggressive. So I think there were plenty of traders that were avoid trading this gold, and there were a few that continued to look down because the market was still bearish. But usually this then results of this is usually a very strong reaction to the completely opposite side. So also it's important to know that when diagonals are finished, you will see a reversal back to the start point of this pattern. So actually at 1345 would be my minimum upward objective for this rally. But if you see here, there's still only first leg up, right? Corrections are always in three waves. Now this clearly is only first wave. So either we will see wave C up after a pullback, or wave 3 up to much higher levels. So I think that there is an opportunity to jump into this trend for sure. Also here on a daily chart, clearly we already have some evidences of an overlapping corrective price action. Okay, I just see this as a very nice setback that is just waiting for you to join the trend.
Right, and your wave 5 target up there is what, around 1320 or so?
100, yes, maybe, as I said here on the weekly, there's a 1345. Maybe this can be triggered. But maybe
and then you only look for that looks like a pretty shallow pullback. You look for, after wave 1s, do you look for 50% or 61.8? Usually,
yes, but the most important are not 50% or 61.8%. The most important to me is price, and the price is identified by swings. So I will probably pay attention to fourth wave levels. Okay, let's assume that we go here, and then we get a pullback. And to me, the most important would be this low of wave 4. Okay. So this would be my first and most important evidence for a potential reversal to the upside. But obviously, in line with this, I will add Fibos as well, and if we'll see that we will be trading around 38.2% near this wave 4, this can already be enough. Okay, so to me, it's more important price rather than Fibos. I'm trying to put Fibos in the context of the price action, if you know what I'm saying. If you know what I mean.
So what would invalidate the bullish call in gold? Trading back under 1112?
Yes, true. Or maybe this, if I connect this trend line, maybe this trend line would already be first signal. But even in that case, I would probably say that wave 1 is already done and that we are already now in wave 2. Okay, so I will then adjust the wave count. So no matter what,
got it.
I think that sooner or later we will see a continuation higher on gold.
Okay.
But maybe we will
go ahead, buddy.
Maybe we will now consolidate if the euro-dollar will turn down, okay, from this wave C, from the 78.6%, then maybe gold could stay trapped in consolidation here.
Yeah, I was thinking one more low in euro and a higher low in gold. What do you think? We get to your parity target in euro, and gold corrects 61.8 from wherever the top is.
That would be perfect.
A higher low.
That would be perfect.
I actually thought we could trade 1110 again, but you don't see that in the cards again at all, do you?
Yes, actually 1110 it's quite low here. Or are you talking about the euro?
That's off the table.
Yes, I think
unless you measure from 1196 to 1290 and we break 1190, that could do it, right? But anyway, I'm getting the picture here that people that are looking for big pullbacks in gold shouldn't be doing so. People that are looking for big pullbacks in S&Ps shouldn't be doing so. And both the trend in gold and the S&Ps is higher. You find that unusual? A long time ago, I followed a guy named Larry Williams who said stock market rallies are healthy as long as the gold isn't going up at the same time as the market. Ever hear of anything like that? And it's not as healthy. The integrity of the rally is that it's more about nominal growth because gold is going up. So it's more about dollar weakness than it is about price appreciation, more like nominal growth.
Yes, very interesting. But actually, I have seen plenty of times those correlations going sometimes even from negative back to positive. between
Yeah,
gold
like
and
how about the yen? How about the yen weakness and how strong equities have been with U.S. dollar yen heading south?
yes, actually this normally dollar yen should be much higher with if you compare it with the stock market.
Yeah,
So actually something is wrong here. It's probably have to do with the yields
yeah,
because treasuries have been moving higher. Obviously, yields were lower, so I think that's
yeah,
the reason why we have some weakness on the dollar.
yeah,
And not,
yeah. It's almost
and
like
not,
that
not to
risk.
do with
That
stock.
was, we should have seen more risk off with the weakness. If you put the yen chart back to the compared to the S&P chart, they both declined and bottomed at the same time, with the S&Ps almost back at all-time highs, and the yen hasn't even retraced 38%. You
Yes.
think that's about the BOJ and central planning? I don't think the BOJ wants U.S. dollar yen to fall beneath 111. I think that's why they
Uh,
went to negative rates, don't you think?
Actually, I'm not so much in these fundamentals simply because I just don't trust them too much. Okay, so
All right,
technically speaking, uh, the price itself is the most important. It has all information from all of the noise from the media, from
right.
every bank, everything. It's all in one place. So no matter where any bank wants to see its currency, I think that it's all about again interpretation and direction of the trend. So I'm still
So
continuing to look.
markets are bigger than central banks anyway.
Yes, I think there are, any other thing it's behind the markets. Everyone are tracking how the markets are behaving, and then they are trying to fit their, I don't know, words, whatever, statement into this price action. So they are one step behind the markets, I would say.
What a great interview, Gregor. Really a pleasure to meet you, and you edified me and Lar today. You ever,
So
you
are we
ever what?
already done?
What's that?
Are we already finished?
What's that?
If we are already finished with the interview, I think
Oh,
no.
if you want to go on, that's fine. But I mainly brought you on to congratulate you. What's the best way for people to find your work, follow your work, become a subscriber, etc.?
We have actually special agreement, as you know, with the FX Street for the FX Street visitors. So they can find my work on the FX Street website, and they will be able to find every other information about my service there. So everything is there. We also, as you know, we do weekly, not weekly, monthly webinars with the FX Street
Okay.
visitors. I share
I
my
want to
views.
I want to
Yes,
check to see if I have your Twitter handle correct. Is it at Grega Horvat FX, Grega or GRE? What
yes.
is it?
GREGAHORVAT. FX.
FX.
Yes.
Got it. Okay, so people could also follow you on Twitter.
Yes, sure.
Anything you want to wrap up with? What what do you think is the most important thing for people to be focused on now that we're in the second quarter of 2016?
What's the most important? The most important is to probably not to trust the current dollar weakness that we have. I just think that we will see some shifts in the trends and that we are still trapped in major consolidation on euro dollar, which makes me think that this whole major trend, bearish trend on euro, is not done yet. So
It
just
hasn't
don't,
it
yes,
hasn't ended yet.
yes, just don't fall in love too much with current bulls
So
on euro.
the dollar index maybe between 94 and 92 is going to be a good buying opportunity because a lot of waivers are saying it's incomplete. We need a wave 5 in the Dixie, maybe up towards 102, 104, something like that.
Yes, actually, I will show you the next chart now. I'll look on the monthly. Okay, now here's a very interesting chart. Now notice that here each decline, let's go back to 2002 and
Yeah,
down to 2004. It was 24 months, very strong bearish impulsive wave. Okay, and after
yeah,
24 months, we have seen move into consolidation phase. Then we have seen another strong decline, another strong leg down that was 27 months. And then market turned, okay? And
Yes.
now when I measured it from here, from May of 2014, when dollar turned higher,
Yes.
and the euro dollar down, I measured and 24 or 27 months, and I came out with a prediction that till July 2016 we could see higher levels here. From April to July, obviously April is now, so we have what, 3-4 months left for
Right.
push higher here up in wave 5. And also here we have this 61.8% retracement, very important level, and from an Elliott wave perspective, we are clearly consolidating here. You can see very strong move up and then just a slow price action. Clearly, that's just a pause with an uptrend. So
okay, so if you're a super bear and you're viewing this as corrective to 105, and A was from 122 to say 72, that from 105 you should be expecting new lows.
From 105, I would be expecting a turning point.
50,
yes,
yeah, 50. Down to 50. The first from 122 to 72 was 50. So from 105, if it's equal to, would be $55 index. Right?
Yes, yes, that's true. But as again, to me that's not the most important. Looking so much into the future. The most important to me is that it will not be a time to be long dollar when the price reaches around 103 to 105. It's probably time to look on the other side. Maybe just for a temporary pullback to the downside with free waves or even impulsive waves. I don't care at this stage. The important is that I see limited upside coming into this year, and that we'll see a reversal. And then when this reversal occurs, there will be opportunities to look for dollar weakness.
Okay, so, well, if the time window that you have up is correct, and it's say June, July, the dollar is going to peak right into the political conventions in July of this year in the U.S.
Well, that's even more interesting then, right?
How about that? Donald Trump or whoever gets the nomination, the dollar peaks on the Republican convention in July.
Yes, but actually I'm not familiar with the cycles, with the trend dollar cycles compared to the this presidential election. So I'm just not sure how if this really is impacting the markets, or it's just some temporary reaction that don't last long.
Well, if Trump is elected, it'd be like Smoot-Hawley 2.0, 30% tariffs against China, all-out trade war. Can't see that being bullish for the dollar. So, okay, what a great interview. I mean, I know what to do in almost every market you showed me for the rest of the year. I don't even need to talk to you anymore.
Okay, so hope you will make some money then.
I'm going to be sitting on the island, and I'm going to give all credit and validation to our conversation today. What a great thing. Now I know why you won, Gregor.
Okay, good.
And you have a lot of conviction. I could tell you have conviction, belief in your work and what you're seeing ahead of time. Isn't it nice to be able to kind of view into the future so you can prepare yourself to take action when the market is entering critical time zones for you?
Sure, of course.
Okay. Well, what did you do? Did you get a trophy from FX Street, and where did you put your award? On your website?
On my website, of course, so that other viewers can see how good we are, and that we promote the FX Street website as well.
Okay, buddy. Well, really nice meeting you, and thank you for all your views that you shared with us for free.
Yeah, thank you for inviting me on your interview, and hope that we will have a new one maybe next year when we won again.
There you go. There's confidence. Everyone, you've listened to, and why don't we give Gregor a large thank you and a congratulations for winning Best Sell Side Analysis on the FX Street 2015 Awards, and follow Gregor's Elliott work. It's top shelf. It's elite. So thanks again, buddy. Good hunting. May pips rain down on you and your customers for the remainder of the year.
Thank you very much.
All right, Gregor.
Okay, have a good day.
You too, buddy.
Bye.
Bye-bye. Everyone doing okay? Pretty good presentation, huh? I did. I think he said he was bearish. Looks like he thinks the dollar's close to a bottom right here, or a push up for new highs into July. What do you think? So guys, I need to take a break now. I'll be back in 5, Adinda. I'm going to take a quick break and I'll be back in 5 minutes. We have another interview with Corvin Cordirla at FX Master Course. See everyone in 5. All right, Goldie, I'm back. Everyone doing okay? Nice work, Goldie. Okay. Here was Goldie's trade. Thank you, Goldie. Gargo's found Kiwi. Two 12 is the key. Right there. Thank you, Rick. How you doing, Mystic? Hello, Ashraf. Ed Z, Carol, GM, Dion, Tozen. What's up, Mystic? That was a nice shot by, I forgot who shorted the 50% retrace in the pound. Worked out pretty good. Here comes Euro pound. Was it Luca that showed the chart or Jake? I think it was Jake that sold the pound at the 50% retrace. Was that you, Jake, or Luca? Who was that, Jake or Luca? That was Luca? Okay, Luca's the man today. So if you coattail Luca, you have 30, 40 pips on his entry, from his entry. Here's Rick's look at Aussie yen. Not rallying while stocks do. Okay. So it's showing inherent weakness. Thank you, Rick. I want to thank Rick. Observation. Okay, Luca, you're the man. I'm giving you the man award. Congratulations. Everyone congratulate Luca on the trip and on receiving his first man award. Congratulations, Luca. Who thinks Luca has been a great addition to our trading community? Give me a why. Here's my why. Jake and Luca, another dynamic duo here in Lar. Wow. Everyone doing okay? Stand by for Corvin Cordirla at FX Master Course. Should be joining us shortly. Stick around. Everyone doing okay? We have another interview. It's a doubleheader day. Play ball, everyone. Baseball season has begun here in the United States, so thought we'd celebrate it with a doubleheader. We just had a weak number. Factory orders came in pretty weak. They fell by 1.7%. Everyone doing all right? Tosin, what are you thinking in S&Ps? You gonna try to 2080? Everyone doing okay? Give me a Y if you could hear me. You guys have gotten pretty quiet. Everyone all right? Rick, you doing okay? Goldie, Dion, Brooke? Okay. Okay. That's perfectly okay. Okay, thank you, Goldie. Thank you, Tosin. Sorry about that, Dion. Brooke, fine, you're okay out here. Now you got a confirmed high here. You get another high. Thank you, Brooke. Everyone see this confirmation? Pretty heavy reading up here, almost 90. I think the Euro Aussie looks similar to that. Crude looks like it wants to pop. Here's my look in gold. Euro Aussie coming out of the top now again.
Hello.
Hi, Corvin.
Hi, Dale. How are you?
Good. How about yourself?
Very good indeed.
Let me ask you this. Are you in the LAR room right now? Are you logged into our room? Because I hear an echo.
You hear an echo.
Yeah, my
Okay.
voice. Okay, better. It's good. We're good.
Okay.
All right, Corbin. Thanks so much for joining us today. How long ago was it the last time you and I talked? When was that?
We had one in December.
Okay.
Hey, I get to see you face to face. I didn't see your face last time. Good to see you. How you
All right.
doing?
Well, happy New Year to you, Corbin.
Thank you very much.
All right. So we just wrapped up the first quarter. A lot of interesting moves. First, in the S&Ps, we had the worst start in stock market history. Then we had the sharpest rebound since 1933. A lot of people came into the year still bullish the dollar. That's been trying their patience as shorts continue to get squeezed in the euro. What do you make of what's happening here? And seems to me like a lot of the omnipotence of central bankers is being chipped away. Draghi comes on, wants a lower euro. It rallies 300-400 pips in his face. Yellen tightens in December, and now she's flying around like a dove. What do you think of this environment? Is it tricky?
Well, it's exciting for starters, and the good thing is you have volatility, which means that you have opportunity. I mean, if you wind the clock back just a couple of years, 2013 and 14, when a lot of things, at least in the currency markets, didn't move, it was quite frustrating. I think at the
Yes.
moment you're seeing, trend followers making substantial amounts of money throughout the start of this year, particularly on the back of these kinds of moves. And so my focus are the FX markets, and certainly from that point of view, it's been very interesting. As you said, euro dollar at the start of the year was at 105, and it's all of a sudden 113. Especially with Draghi indicating that they're more or less at their lower bound for negative rates, and Yellen all of a sudden saying that, and she's not quite keen to hike as aggressively as before. All that short euro position is going to be unwound. I wouldn't be surprised if this thing actually manages to go up to 120 over the next couple of months.
Interesting. So this time we're going to do something a little different because we're going to screen share because a picture speaks 1,000 words. If you go up to the upper left-hand corner, you'll see a green box with an arrow.
Got you.
And you click that, and then you'll see different desktops pop up after you click it, and then you could show us your screen. You click on the...
Okay, let's try. So will I see what I share? Okay, so...
You should, yeah. Okay, so here we are. We have a naked chart using green candles of the daily Euro USD.
Yes, that's right.
Tell us what you see.
I wanted to talk through a couple of instruments today. You suggested that as well. Before I start doing that, I wanted to just sort of lay out what my approach to the markets is, which is probably slightly different than technical analysis on a very short-term frame. So I'm going to pull up a PowerPoint. Can you see this?
Yes.
Okay, so, but you, okay, well,
no,
let's just
we a total FX benchmark is showing.
Yeah, okay. I've got the slideshow on my right screen. Well, it'll be big enough. Let me zoom in. So this is really what the picture is. So this is essentially a trading approach to FX. It's very subjective. It's rule-based. It's back-tested on data, interest rate, and currency data all the way back to 1991. So what's the purpose of showing you this? Currencies are really driven by several factors. So in equity markets, we know that value stocks tend to outperform growth stocks on average. You have that smaller companies outperform bigger companies, and you also have momentum-driven stuff. So what are the factors that drive currencies And there's really three factors here. One of them is interest rates, interest rate differentials. We already broached that subject with regards to euro dollar. So Draghi, as a central banker, and Yellen will have varying policy adjustments they must implement, and that, of course, will affect the way people reprice euro dollar, for instance. So what does interest rates mean in particular for currency markets? It means that people tend to chase the high-yielding currency versus the low-yielding currency. So a classic example used to be Aussie versus the yen. People tend to buy the Aussie over the yen because Aussie yields 2.5%, whereas yen at the moment has negative interest rates. So just by holding Aussie yen, even if it doesn't move, you're making 3% annualized without any leverage. Obviously, if you use the kind of leverage that people tend to use in the currency markets, you can make much more. The
so
other
is this
factor,
what we're looking at right here, Corvin? Is this your performance, or what does this represent? This chart that I'm looking at here from 1994.
It represents the performance of a set of strategies that are driven by fundamental factors. So one of them would be interest rates. So the interest rate approach to currency markets flows into this chart, and I'll go through the actual subcomponents in a second. So besides
are these trading programs that you use? This is your result?
No, obviously not going back to
1991.
Not going back to 1991 because certainly I wasn't around at that time. This has been traded from 2007 towards the end of 2000 or middle of 2009. Certainly the performance afterwards again is back-tested because ultimately when I was running my fund, I was very much intraday trading, intra-week trading probably 100 trades a week. My focus, however, has now gone much more long-term. I don't believe that people who sit at their desk and don't have access to infrastructure will be able to achieve performance on an intraday level that maybe funds with the technology that they have at their disposal can achieve. And so really the ultimate question comes, what does it mean to generate long-term growth? Do you have to follow every news announcement? Do you have to follow every intraday move? And the answer is no. The answer is that if you actually look at a very simple set of rules and factors that drive the currency markets, you can generate long-term performance. And it's underpinned by economic factors. And that's really what this chart represents. So I'll start out with, so we covered interest rates. So as a classic example, so at the moment, the biggest interest rate differential, so if we bring up some charts, at the moment is between Kiwi Swiss and Aussie Swiss. So the great thing of going about looking at the various factors that influence the currency markets is you tend up looking at currency pairs that a lot of people don't look at. So if I bring up something like Aussie Swiss at the moment, as you can see over the last month, it's been sideways range bound, and most likely going to continue staying in that range. Probably going to bounce up, but two things are going to happen here. Not only are you earning 3% annualized just by holding this currency, but by trading in the short term around it, you can obviously exploit the upward move that is natural in the trend at the moment. So we obviously are, at least over the short term, the last 2 months, an upward trend at the lower bound of this short-term channel. And just by holding this currency, you're making money on the carry, and at the same time, you're going to also exploit the move that you can see moving upwards. So that's the purpose of that benchmark. You understand what the underlying fundamental factors are, and you can therefore really help your shorter-term trading because that benchmark is only rebalanced on a monthly basis. Obviously, you can trade over a week or over 2 weeks that particular currency pair. Another example of a high interest rate difference currency pair at the moment is Kiwi Swiss. If I bring up the Kiwi Swiss chart, you've got the same situation. It's at the moment bouncing in the 400 pip range, and it has been doing that actually for months now. So that will most likely continue. But just by holding this currency, you're earning 3% annualized. So if you trade as most people do,
which is a big deal in a zero to negative interest rate environment.
Pardon?
Which is a big deal in a zero or negative interest rate environment. A 3% yield is pretty good.
Well, exactly. So at the moment, Kiwi's yielding something like 2.5, 2.6%, and the Swiss actually giving you minus interest rates, minus 0.75 at the moment. So the difference between this is actually 3.5%. So as with most people, you know, if you're probably trading this kind of stuff at, let's say, 5 or 10 times leverage, that means 30% annualized, at least over the month. It means between 3 and 4% that you can make on your account. And if you trade around the ranges that are forming, you can get an added kicker just by trading the range at the moment. So it's always important to understand, you know, what other factor besides just the actual spot move is driving this particular pair I'm looking at. And therefore, the kind of approach to looking at factors like that, it makes you end up looking at currency pairs which other people usually don't look at, such as, for instance, the Scandi pairs, dollar NAKI, and we'll come to that in a second as well.
Okay. So this is an institutional. This is pretty much an institutional approach to the FX markets, where they're retail traders. You know, unless they have sizable accounts, that 3% should appeal to them, but it doesn't appeal to them.
Well, no, but that's with one-time leverage. Now, who actually in the retail space trades on one-time leverage? Yeah.
Right. Good point. But a very interesting approach.
So obviously if you increase your leverage and you get the entry points right, you get a double whammy. You get the interest rate differential that gets debited to you, credited to you, and of course you get the added benefit of the spot move.
Okay.
So that's really one factor. It's about interest rates. The other factor is the value factor. So here's actually that subcomponent of the chart I showed before, which just looks at what happens if I were to only trade value in the currency market over the last 20 years. So value is an interesting idea. Value comes from the fact that imagine you go to I go to the States on holiday and I buy an Evian bottle. Yeah, it's a French manufacturer, bottles it up in a plastic bottle, sticks a label on it. So I bring this bottle unopened back to London, but guess what? In London, in the newspaper stand, there's exactly the same bottle over there. Yeah. So I could effectively swap these two bottles against each other. Nobody would notice. Now, let's say I bought that US bottle for $1.30, and the London bottle I bought for £1. So the effective exchange rate should be $1.30 to the pound. But then I look into the market and I see in the market it's quoted 145. So the market, in some sense, is overpricing sterling compared to what it actually is, and so it naturally lends you to sell sterling. So that's how you can establish a value. Now, obviously, you don't have to go and look at the price of goods in every country. You can easily look up what these good-based prices for exchange rates are at websites such as the IMF or the OECD. If you look up the PPP values, and then the idea is to find the most undervalued currency and the most overvalued, and trade one against the other. So the example, for instance, recently has been on two currency pairs, the Euro Swiss and the Aussie CAD. So Euro Swiss actually, forget about this drop, of course, was extremely interesting after the SMB decided to remove its floor. But ever since then, you've seen that Euro actually at the moment is the most undervalued currency across the majors, and Swiss is the most
I know these events like the S&P coming off the peg are exceptions, not the rules. But if you had been executing that strategy going into it, would that have been a huge hit?
Well, actually, no, because you see, it dropped by something like 20–25%. So that wouldn't have been on your radar because Swiss at that time was massively overvalued as it is presently. So you wouldn't have traded the Swiss. And of course, people tend to be a bit just because of this kind of potential intervention, but this requires some nimbleness on your feet and being able to understand what the markets are doing. I mean, let's wind the clock back to the Euro Swiss situation, and you can definitely see where the floor was at 120 for these people. Right. By trading something that's floored and that's pegged, you're always effectively selling optionality into the market against such a massive move that's going to happen to you. So you are very well aware of the peg risk that exists. If you should be willing to take that peg risk, then well, that's part of the risk management process. The whole point, however, is back then in January of 2015, the issue wasn't that you would have even looked at this pair because overvaluation didn't exist at that time for the Swiss franc.
Got it.
However, if you actually look at what happened to the Swiss franc ever since then, it's been selling off quite nicely versus the euro. Euro Swiss has been appreciating, and that's another way that you can exploit it. And so, for anybody who is a fan of chartists, you obviously at the moment are looking at this thing being on this trend line. You understand that from a fundamental factor, the trend is up, and so this would be a good entry opportunity for Euro Swiss to see it go all the way up, maybe to 112, 113 over the next 2 to 3 months.
Okay.
Actually, another example in terms of overvaluation, undervaluation leads you to another interesting currency cross, which is the Aussie CAD. So with obviously the CAD move that we experienced in dollar CAD due to oil over the last year, CAD has become actually quite undervalued. And even now that it's reverted, it's still undervalued, quite undervalued compared to the other currencies. And that leads you to something like the Aussie, which is still actually overvalued, even though it's declined so much. So being short Aussie CAD, actually, from this valuation perspective, is one trade that this portfolio recommends. And interestingly, again, rather than just trade the portfolio naively, look, I'm being told Aussie CAD is great because Aussie is overvalued and CAD is undervalued, and being short Aussie CAD, I can look at the technical setup, and as you can see, it's bouncing against resistance at 1. It's now at the moment around about 99, and it looks like an opportune moment. You can always put your stops in really tight. It hasn't been this high now for something like 1.5 years. So the downside is actually much more likely, and you're being given fundamental reasons as to why you should be short Aussie CAD at the moment.
And is there a yield differential in your favor on that?
Well, in this particular case, now that's an interesting question. CAD actually has quite low interest rates at the moment. Aussie has quite big ones. So in this particular case, the interest rate differential would work against you. But now, that is actually quite interesting because obviously let's say you've put on the Aussie-Swiss position we talked about previously. At least what you're doing is you're managing to cancel one out versus the other from a portfolio perspective by trading long Aussie-Swiss and short Aussie CAD. At the same time, you're getting the benefit of the added directionality that you can infer from the charts.
Very interesting.
So this is where it becomes interesting because a lot of people tend to only look at one currency pair and try to have a system on the back of that. What I'm really saying,
you're a portfolio manager of currencies.
Precisely, and that's in the end how you can extract the value and get the smoothness of your returns. Because if you're always stuck to only one instrument and maybe one or two systems, guess what? You're going to be hit at some point in time, and the pain can be much bigger in a situation like that when you're very focused, rather than when you're more spread out across different benchmark, different currency pairs.
What a great! I'm so glad I invited you back, because we really haven't had a presentation like this, looking at the whole currency complex as, like you were talking earlier, like growth stocks and small caps, and how to take advantage of over and undervaluation rather than just making directional bets.
Well, actually, interesting you said directional bets, because obviously the other one, besides just interest rate differentials and valuation, we still have momentum, especially in the currency markets, and you can't overlook that. I mean, why do you think trend-following funds are so successful? Because trends do exist. I mean, you can explain it sideways, that you have crowd behavior and herd following and all that stuff, but the point is it does exist and we can observe it, and so obviously that's another factor that plays quite deeply into the portfolio construction I'm talking about, and that probably, you know, can pique some people's interests in terms of what I'm going to present now. The key here is it's not short-term momentum, it's momentum as you've observed it over the last 3 months. It seems that 3 months is kind of the optimal period over which to look at momentum. And obviously the big loser, or a loser against the dollar over the last 3 months, has been sterling. It's had some phenomenal moves. And at the same time, the big gainer against the dollar has been yen. You know, I mean, that's a phenomenal depreciation of something like 10% over the last 3-4 months. So if you combine the two, of course, sterling yen, the last 3 months had the best, something like 15% decline. Had you been on a trend, that would have been phenomenal. And certainly just looking previously at the momentum that you observed, you would have actually captured the last 2 months of momentum. So the whole point about momentum is you believe the trend will continue. So looking or taking sterling yen, the portfolio would actually want to put you into short sterling. And this is what I call a puke trade at the moment. Why? Because, you know, naturally you're looking at this thing, it's already come down from 195 all the way down to 160. It looks like it's bottoming out, and a lot of people would just not have the guts to put this trade on. To be quite honest, I'd be very scared to put this trade on as well, and so the question is, how do you manage it over the short term? But certainly part of the portfolio says you should put on sterling yen to the short side and let it play out over the next month. Most likely it will decline. Of course, momentum tends to be amplified by catalysts in the market, and the great thing we of course have at the moment for sterling is this Brexit story. And as more polls are coming up and as more people are realizing that actually getting out of the European Union is quite likely, you can imagine the history that's going to fall on the back of sterling, and the pound being completely smashed probably into May and June as the elections come up.
Do you think there will be a Brexit? Most people are poo-pooing it. You think there will be?
Well,
and would one more terrorist attack in mainland Europe seal the deal? And isn't that why polls are moving in that direction?
I think that's part of it. But what's interesting, you see, I actually live here in London. Obviously, I'm not from England, but you get to meet a lot of English people and ask their opinion. You tend to find that the foreigners or the European citizens who work in London, they obviously have a preference for England to stay in. But it's not up to them, it's up to the English people. And really the perception here is that why should we be part of a political union where we seemingly spend subsidies or have to pay subsidies every year in large amounts, we have no control over our political environment. There was this human rights bill that essentially is being run out of Brussels rather than England, etc., etc. It's this idea of identity, nation identity. And I'll tell you the really scary thing is, for some reason over the last 10 years, I think it's really kicked off with this war on terror in 2001, the world has become much more inward looking. You know, every nation wants to be its own master. This idea of open boundaries and open borders, on paper maybe, but in reality people really don't want that. And boundaries are going up again. I mean,
the rise of nationalism.
No, completely. I mean, just look at, you know, Donald Trump. I mean, God knows if he's going to win or not, but he provides us overseas with endless funds.
Okay. All right. So go ahead.
No, the only thing I just wanted to add was in Europe you can definitely see it. No, I mean the Basques want to separate from Spain. People want to shut their borders to migrants because of the influx from the Middle East. So would I be surprised if England exits? Not at all. I mean, I think it would be, even according to the polls, if you adjust the polls by the likelihood of people voting, the polls are very much in favor of leaving.
So it could end up being the pound selling off, sell the rumor, buy the fact into the event.
It could be, but here's the really scary thing. If you actually wind the clock back on sterling all the way back to the 1980s, at one point there was a parity. It was like a 105 versus the dollar. So could it go that low? I mean, there's a definite possibility. So trading sterling right into the last month or two before this June 23rd election referendum, it's going to be a tricky business, and people should really be on their feet and nimble to see exactly how to trade that market.
Or not trade it at all.
Or not trade it at all, but yeah, it depends on your position.
Yeah, that's always an option, isn't it?
It is. Well, talking of momentum, we briefly mentioned Eurodollar at the beginning of the show, and one of the things that is interesting is if you bring up the Eurodollar chart again, it was at 105, it's now at 113, 114, and that's really driven off central bank policy. And if you actually wind the clock back and you sort of zoom out, you're now actually at exactly this kind of range prior to which you collapsed into at the start of 2015, especially on the back of this quantitative easing out of Europe. And as people realize that the European Central Bank might be done with, or is done with, negative interest rates, and God knows how many bonds they can really buy up, and that Yellen might not have the heart to really hike up interest rates anytime soon, you're going to have an unwind of this. So momentum is not just about what was the biggest momentum in the past, but what's starting to amplify going forward. And one of the biggest momentum factors that is increasing at the moment is on Eurodollar in terms of acceleration. So that's going back to what I said before. I can definitely see Eurodollar going to 120 over the next 3 to 4 months. I think a very good indicator will be how it behaves this month if it manages to break above 114.50 and stay there with definite support, and I think that's a great trade to look forward for the rest of the year as it does go up back to 120, 124. And interestingly, its fair value, according to purchasing power parity, so this idea of valuation of goods, is at the moment, according to the OECD, at 124. So euro is still massively undervalued, which was the reason you bought it versus the Swiss franc. But even in the case of the euro,
just call this a rectangle. And let's call it 1,000 pip range between 104 and 114. Just a measured move gives you 124, which is purchasing power parity. Is that what you're saying? It is?
Yes. Yeah.
Okay, so you have a fundamental argument and a technical argument pointing towards the same outcome.
Now, of course, I mean, the most interesting thing is going back to sort of technicals or chart patterns. This is here clearly a double bottom. And as far as I can, or I understand, if I understand this correctly, this kind of setup usually indicates that the market really has no desire to move any lower on this, and that the upside is definitely there to be had.
And I think there would also be some type of fib retracement up there, maybe halfway back from the 140 slide, something like that. Okay, well,
yeah,
a lot of confluence pointing towards the same outcome.
Definitely, it's beautiful.
Okay.
Now, obviously, it's not just about the long-term influences on the currency market, so the 1 month, 3 month, 6 month influences. It's also on the short-term side. On the short-term side, mean reversion on currencies plays a big factor. And currencies aren't like Yahoo stock that starts out at 10, goes to 100, and comes back down to 10. They tend to oscillate heavily in given ranges, and that's the nature of the beast. You're not going to wake up one day and all of a sudden Eurodollar is going to be priced at 5 or at 10. And you can definitely test for that, at least from a statistical perspective. But I wanted to show you a strategy with regards to mean reversion over the weekly time scale. So this is effectively what this chart shows you is if every week you'd gone into the market and you'd sold the most trendy currency of the previous week and bought the least or the one that went down the most. So it's like you're mean reverting. So you're selling the best performer, you're buying the worst performer. So in this particular situation at the moment, we'd have sterling Kiwi. So sterling was the worst performing currency. Kiwi actually was the best performing last week. So sterling Kiwi as a combination was the worst performer last week. And it already has posted quite a big bounce. So for people who are interested in much shorter time horizons, looking at that combination, looking across all possible currency pairs and identifying what's gone the most last week and then trade against it, that's a viable strategy that can be quite successful. So in this particular case, it was sterling going long Kiwi sterling at the start of this week, so just the last 15 hours. And the previous week, actually, it was sterling Swiss. So I'm going to give you an example here of what it means to trade very simple rules. Trading very simple rules means that you can overlay them with your own understanding of the market. So the previous week, sterling Swiss was the worst performer. It did bounce into midweek, but then it sold off again massively towards the end of the week. So the idea of imposing your own stop-loss mechanisms on a portfolio approach means that you can definitely outperform the portfolio. So it's like, the equity traders will look at the S&P and say, I can do better than the S&P. So that's the whole point about having an FX benchmark that's made up of really, really simple rules, because then you can ask yourself, how can I perform? How can I be better than this? And if this is already tremendously good, it means I'm starting from an advantageous position. So imagine a guy who's just looking at moving averages on currencies. He has no clue if these moving averages would have made money or wouldn't have made money. The whole point about starting from an approach that's worked in the long term is you're starting from somewhere already in the plus. You don't have to worry about this thing working out. You can just worry about outperforming it rather than, hey, am I making any money at all here?
Interesting.
And I think in terms of mean reversion, currencies don't just mean revert over the very short term, they also mean revert over the very long term. And that actually brings you to an interesting, I like the Scandis. I like the Scandinavian currencies, Swedish kroner and Norwegian kroner. And I know that a lot of people might not look at that, but they're fantastic currencies to trade if you have more capital. And the chart I'm bringing up here actually is a monthly chart of the Norwegian krone. And it's looking at the 50-month moving average. That's the yellow line over here. Yeah. And in essence, what you're doing is you're going across all your currency pairs, and you're looking which currency pair is the furthest away from this moving average. And I'm just going to trade it the other way. So in this particular case, dollar NAKI is the longest away from its moving average to the upside. And so a great thing to do it now be to short dollar NAKI. And there's actually much more interesting fundamental reasons for that. Dollar NAKI, if you actually look at the 20, 30 years of this currency, which I don't have here on this chart, you'll see that it's more or less at its all-time high. The all-time high is actually the upper boundary I've marked here at 980. It's, this at the moment, as far as I can tell, will be a one-way street right down all the way back to 6, which is around about 2,500 points.
Wow.
So managing that short side would be very profitable.
Okay. What a, hullabaloo of great ideas and interesting approaches. How do you combine all of these? How do you combine all of them in a portfolio? Is it difficult to have all these different strategies working for you at the same time, or are there times when one is more advantageous to be in than the other?
It's, in the end, it's all about, I run this off a spreadsheet because, I don't have to be on top of it every minute. I look at it at the end of the week, and that will more or less put up what positions I should have. And then, as I said, I've done a lot of intraday trading in the past, so I do have that kind of bias. I will actually check if the short-term technicals do coincide with this longer-term view, and then I'll put the positions on with appropriate stops where I think. But it's really just about creating a benchmark portfolio for the week. So every system will say, go short dollar NAKI, go short Aussie CAD, go long Aussie Swiss. In the end, you bring up the charts. Should I do that? Shouldn't I do that? Where are my stops? And I just run it for the week and then see what happens. And I rebalance at the start of every week or every 2 weeks. So from an implementation perspective, it's straightforward.
Okay. Okay.
I suppose, I like talking, and I like talking fast, so I apologize for the fact that I think I've steamrollered you. And there's
the advantage is it's recorded. There's so much information in this interview that I'll have to go back and play it again. But that's the advantage of having this recorded. This was a great presentation and unique and unusual presentation from what I normally get. And you've broken down so many different trading philosophies and styles and rationales behind them. It was really a great interview, Corvin.
Thank you. I mean, I think, do we still have time, or
Yeah.
what's?
Yeah, sure we do. We have time.
I mean, I suppose one of the things that I haven't done here is, because I think right at the start you mentioned what happened in the equity markets, for instance, and I certainly what happened in the commodity markets. We haven't really broached that subject at all. But what's interesting is, I don't know how many of your viewers look at ETFs.
I do.
But you know, there's one great ETF out there, which is the iShares U.S. Aggregate Bond Index, run I think by BlackRock, used to be Barclays Capital, and prior to that Lehman Brothers. But if you just bring up a chart of that, that's like, you know, you want to get rich quick, just like buy that thing, leverage it, and run it for the next 10 years, and you're going to make $1 million out of 10,000. I mean, it's just such a wonderful instrument. And the reason for that is, you know, there's been a tremendous bull market in bonds. It's not just made up of government bonds, it's made up of other credit bonds and mortgage bonds, and they're going to provide value. But the underlying idea about this aggregate bond index is if you start to combine bonds with equities, even in very simple ways, you can really get a kick out of your portfolio. So how does FX come into this? Well, now you have an FX portfolio that you can actually, with pencil and paper, validate that it works, and you can stick it to your other asset classes. So for people who have a broader view of the markets, the bond market, the equity market, now you have a way of approaching the currency market, which isn't just, you know, an exchange rate I have to look at when I go to another country to visit for tourism. I can actually use it to create value over the long term, and that's really the approach that I advocate and that I implement, because you need to have a rationale as to why to trade an asset. You know, people buy houses because they know house prices are going to go up, or they can get rental yield off them. So why the hell would you want to buy or invest in currencies if you don't have a long-term perspective on the back of that? Because the short term isn't going to make you money. I mean, I think there's a famous saying here, you know, if you're only looking to invest over a 5-minute holding period, you're not going to make money. The money's really made by just buying something and holding it and just seeing it go to the sky.
Since you touched upon it, any views on what's happening in the commodity complex and the equity complex? You know, we have that worst start and then a huge rebound. Do you think risk on continues for equities? And I know a lot of global bourses are well behind the U.S. performance and recovery. Do you have a view on that, and does it affect your outlook on your FX programs?
Well, I think you mentioned it there. It's in terms of risk, and risk on and risk off. And of course, the S&P goes hand in hand with the VIX, with the volatility index. And the volatility index tends to be observed by many people, not just for equity markets, but for other markets as well. And that definitely does play into the currency market, because when you get heightened volatility or a heightened fear of risk, a lot of strategies will get hit. Like a carry strategy that lives off making interest rates while times are quiet will get hit when times are turbulent. And so it's good to have a view on what your other assets are doing, which represent risk. I mean, the S&P at the moment, it's done phenomenally well, but you still have that massive barrier, 2,100. So are you going to overcome it? What's the catalyst that's going to push you upwards? I mean, I can definitely see that currently it's a combination of the fact that interest rates are not going to get hiked as fast, and that you're getting, you know, okay-ish unemployment numbers out of the States. And so both these factors probably driving equities high, but can they drive them higher is the real question. And so as long as it doesn't go above 2,100, I just, you know, probably my bias would be towards the short side.
Okay, however, and how about gold? How about gold that had its best quarter in I don't know how many years, which is a currency into itself, and a lot of people were bearish gold because of the opportunity cost of yielding zero plus carrying charges, storage. But now that we've moved to zero rates or negative rates, that opportunity cost in owning gold has gone away. Gold figure into your overview?
It's well, I have a view on gold, and it certainly doesn't figure into this portfolio construction per se, because I think gold is pretty much a universal currency. So to whom do you attribute it to, and what kind of sort of specific country factors can you associate with it? I think look, gold has always been an inflation hedge. So if gold moves up, you got to ask yourself, what's the perception people have about inflation, and is all this money that's being pumped into the economy going to add up to anything? But that brings you to a completely different story. If inflation isn't perceived to go up, what does that tell you about how the economy is going to grow and people's outlook on risk assets such as equity markets? If equity markets will stall, aren't going to go up higher, or they're going to sell off, if all that money in the economy at the moment isn't going to feed through to small to medium sized enterprises and consumers, it's just going to be stuck in limbo, and people are not spending, and inflation stays down, it could be, a very nasty situation, which gold probably will continue to go to the upside. That's sort of a very high level view, but as I said, gold is not the biggest of my focuses with regards to the instruments I trade.
Okay. So I know you have a course because your handle is FX Master Course. So
yeah, it's not the most creative of handles.
Excuse me?
It's not the most creative of handles.
Okay. Well, but it does accurately say what you have. So you have a course. Do you also manage money?
I have until I have up to the 31st of December, at which point I exited my fund. The fund is still being run by my business partners, but I myself have now fully retired from that and managing my own money and focusing on education.
Okay. So besides the course, why don't you tell us a little bit about the course and how you teach it, what's the environment? Tell us a little bit about your course.
Well, I think in this interview, really, you've seen a high-level approach in terms of identifying the factors that drive currency markets, creating portfolios, and tactically trading around them to outperform the benchmark. That's really what I teach in a nutshell.
Okay.
By several factors. One of them is, as I saw, in running my fund and my systems, we would trade something like 100 trades a day. And one of the things that you tend to find in that kind of situation is that you're very constrained. You're technology constrained, you're liquidity constrained, and you have to be on top of things all the time. And trading ultimately should lead to freedom and not another job to stare at the screen. And that also then translates into taking a long-term view. Talking of which, I can tell you some very funny stories about high-frequency traders at banks or high-frequency firms who are probably not high-frequency in their life. I mean, some of them take something like a week to decide which restaurant they want to go to meet up for dinner. And I think it's that kind of long-term approach that in the end makes you a lot of money. I mean, all you have to do is pull up a chart of Berkshire Hathaway to see where I'm coming from. Because ultimately, once you have a very sort of straightforward methodology, you can then start to think about leverage. And that's really the added component of the course. What does it mean to manage your money properly once you have an edge? Because you see, as a hedge fund guy, why do you think somebody comes to you and invests with you and pays you 2% management fee if he can do the same thing just by buying a bond index? So if he comes to you and he says, what do you do? And you say, I take the long-term approach and I do sort of very straightforward portfolio construction, he's going to say to you, well, I'm not going to invest with you because I want magic, I want hocus pocus, I want neural networks and wavelets and God knows what. That's sort of the pressure hedge funds live under. But as private investors, we have the opportunity and the luxury to exploit any edge, no matter how simple and straightforward it is. And within the FX markets, that's the thing I presented, and that's the thing I teach in a very methodical way, so that anybody, regardless of kind of numerical background or not, all you have to be able to do is put a number in the spreadsheet to see what comes out. And I take you by the hand because the purpose is to create a framework of thought about the markets. It's not just sufficient to say, well, here are the rules, follow them, and that's it, because the markets change. So if you understand why the rules are motivated, you can change your approach as well. And ultimately, what I'm really trying to get out of people is for them to think about the underlying factors that drive the markets, be able to identify them in an objective way, and then be able to exploit that to create, hard and fast black and white portfolios that generate long-term growth, and then use the leverage to really kick it out of the ballpark.
Thank you so much for your time today. I really enjoyed it. I'm going to be replaying your interview, Corvin. Let me ask you this: with your kind of strategies, what kind of equity do people really need to make it worth their while to take your course and execute what you teach?
So I really believe you can double your money if you use the right leverage and the right risk approach within a year. Do I believe you can double your money within a month? Well, if you're lucky, yes, but you're also going to go to the poorhouse very quickly. But here's the other issue. If you start with $1,000 and you double it, you have only made $1,000. Now, on a percentage basis, this is going to sound really remarkable, but in nominal terms, notional terms, it's not going to be neither here nor there. It's just not going to be interesting, and the motivation wanes. So what I say to people is, even if you start with $1,000 or $5,000, you should see your trading account as a long-term investment, where like with a 401k in the States or an ISA here in England, you keep on topping it up with cash so that your growth accelerates. Because ultimately, you're going to have real fun making money when the money you make is $50,000 or $100,000 in a year. If all you're making is $1,000 or $2,000 a year, it's not going to be fun. So the amount of capital you put in is going to be directly proportional to the amount you take out. So it requires really a certain mindset to be able to understand that psychological conundrum and to be willing to work at it and keep on investing in yourself. And the act of investing in yourself, sticking to the rules, will make you wealthy, but it requires that discipline. So yes, you can start with as little as $1,000 or $5,000 because we have these nano lots, and the FX market is phenomenal in that respect. But if you really want to make money, you have to come at it with significant capital. But as I said, you can grow that, and it's about discipline and commitment to make it grow, which you can definitely do.
What do you charge for your course?
Well, actually, I'm launching a live webinar series next week, and if you sign up to my newsletter, you'll start getting a series of emails explaining what it's all about, and that's priced at $897. It'll be 8 weeks with me, 2 hours a week, where I will have 1 hour every week of covering the material and 1 hour of Q&A, and follow on in terms of helping people set up their stuff. For those who want to one-on-one calls, and the idea is not just to sell this webinar series, but also to set up a community, a group. So again, in terms of the long term, once people come on board, I will be running the portfolio so that they can see how it's managed. At the same time, they can copy and implement. But we really support each other as a tribe, as a network, to see each other grow wealthy. So if you want to, it is a hedge fund, but it's a completely decentralized hedge fund where people manage their own money, but you have a forum in which you can discuss, you can learn new ideas, and you can support each other. One of the things I found with people who trade for themselves, and especially myself and my fund, it's a very solitary enterprise. You don't have other people whom you can talk to. I know you've got these trading rooms, but the issue with trading rooms is it's like hot houses. If you don't perform, you haven't made a trade in an hour, and you haven't made money. Oh my God, it's a catastrophe. Here, it's really about talking to each other to create a support, a bedrock, so that you can exploit the long term, and in the end, hopefully, build relationships that last for a long time.
Yeah, and you have to be patient, and waiting is the hardest part.
But if you wait in a group, now obviously I'll be sort of the core of this community for this at the start, and really support people. Then that's just a great environment to be in.
Well, you're preaching to the choir when you talk about the strength of being in a community. So I'm a big believer in that. So I wish you a lot of luck on this new series, and thank you so much for your time today, Corvin. Good luck and good hunting, and really appreciate you showing, tying in fundamentals with how to pull equity out of the market by taking advantage of these different modalities that you showed us today.
Thank you very much for having me on the show, Dale. I really, really appreciate that.
All right, partner. Good hunting. Everyone thank Corvin Cordirla for his time today. You could follow him at FX Master Course. Do you have a website address you want to throw out there?
Yeah, the website is fxmastercourse.com.
Okay, I could have guessed. All right. Thank you so much, Corvin. Good hunting, buddy. And talk to you soon.
Take care.
Bye-bye. Everyone enjoy that? Pretty unique approach. We have another webinar. Okay. So then I'm going to skip. So I'm going to skip the wrap up. And we had a couple interviews. We'll get more into the markets tomorrow. Thank you, everybody. Thank you, Adinda, Sinatra, Luca, Ricardo, Brooke, JM, FX Goldie, Dion, Tosin, Mystic, Khalid, Ziggy, Ashraf, GM, Carol, Valguy, Pegasus, Ron, Ed Z, Mauricio, Jake, Abel. Thank you, everyone. Oh, Mauricio wants me to do a recap. Okay, so here's a recap. I still think there's more upside left in the euro. I'd be looking to be a buyer if it's an ABC down here towards 112.75. Not sure if this is it in the pound. US dollar yen, I'd be looking for some type of recovery from lower levels. And euro pound, I'm still looking for one more high in euro pound because of this confirmed high. And that'll probably happen with the euro. I still think has at least 115.5 in it. So that's my wrap up. Hi, Ray. Thank you, Ray. See everyone tomorrow. Adios.